Well, Victor, welcome back to another episode of the Beconomics podcast. I think we have an exciting episode for us today. Yeah, it's something that's on the minds of a lot of investors, especially early in their investing career. It's that decision between active security selection or just passive management. And so, I think there are pros and cons to both, and they fit different investors, one better than the other a little bit, but I'm excited to get into those weeds as we go along here. And as a note, if you're liking the content you're seeing, then remember to leave a like and subscribe, as well as leave us a comment if there's anything you want us to talk about on the future episode of the Beconomics podcast.
Yeah, Hunter, I think this is a topic that continues to come up more and more frequently in the modern investing era is, hey, should I just passively invest what I have? Should I work with an advisor? Should I try to pick my own stocks? And I think that's a really good conversation to kind of walk through as far as what makes sense for who, because everybody's going to be different. In some cases, I think maybe the passive route makes sense. In other cases, we would definitely suggest to someone active management is going to be the better option. And so I guess we'll kind of start with passive investing. And obviously there are things that are attractive about it. It's very easy. If I'm just going to throw some money into an investment portfolio, I can do it through, a Fidelity or Schwab or, Robinhood, if you will, put it into SPY or put it into a combination of the S&P 500 and, the Bloomberg Ag Bond Index, call it a 60-40 portfolio. And then hopefully I wake up in, 30 years and it's worth significantly more than it is today. I mean, that's certainly an approach. And a lot of people take that one. I think that because of the ease of it, it is a great tool for investors. I will say that it's nice to have access to these things because it's getting more people invested in the first place. And this is something that we will always pitch to people, whether they're going to do their own investing passively, whether they're going to try to pick their own stocks, whether they're going to invest with individuals like us. It's that getting invested is really step number one, because you want to make your money work for you. You don't need a bunch of money sitting in your checking account. I mean, sure, it's fun to watch that number go up, but it's not keeping up with inflation at that point. It's just slowly eroding away. So you want that money to work for you. And especially if you're a younger individual or you don't expect to retire, for at least call it just even 5 years. I mean, you want that money working for you, growing alongside you. So while you are working your own job, hey, you're making an income and you can save a portion of that. But then also you've got this money that you've saved up over the other part of your life that's working for you too. So I kind of want to start the conversation there, but then definitely want to talk about the benefits of that passive versus active investing.
Yeah, off that point, I think there's a lot of positives about it. And one further step I'd like to add is get invested, but also stay invested, because that's something that we see a lot with people, especially when they want to go at it alone. It's all good, fine and dandy until the markets turn. And inevitably they do. Long term, they go up and generally, and we're, happy about that. And that's what makes it work. That's why people invest in the stock market instead of just cash. But during rough times, it can be really difficult to stay invested if you're going at it by yourself, if you don't have a partner there. And a number of reasons can make that happen. The conviction of what you're holding and why you're holding it. But first off, I really just want to address one of the things that's been highlighted more and more in the recent history is the concentration of these indexes. So when you're buying the S&P 500, it's a market cap weighted index. So that means you're buying significantly more of Apple, Nvidia, Google, all the mega caps of really large companies make up a much bigger percentage. The top 10 companies in the S&P 500 make up about 36% of it. So you're really not buying effectively 500 stocks. You're buying closer to effectively 50. Just based on the weightings of them all. So that's just something to keep in mind. Doesn't mean you can't diversify further by buying both the S&P 500 and the NASDAQ. That's another approach, and you can always, add layers to this. But as you add more layers and more complexity, that starts to take some of those advantages of passive indexing away from you.
Yeah. And I think, to your point, the index has become less and less diversified as time has gone on. If you look 20 years ago, S&P 500 was a pretty relatively well diversified index. You didn't have these huge overweights in the top 10. I mean, if you look at a chart of how the top 10 has trended as a percentage of the S&P 500, I mean, it's pretty much up and to the right. It's really increased over time, especially with the sector dynamics involved. The tech sector has become a huge portion of the S&P 500 that it didn't used to be. Used to have better dispersion across the 11 sectors. Now it's a lot of tech, a lot of communications. And so you aren't as diversified as you used to be, which is a little bit to your passive investors' dismay in bad markets, because if you have a few of these companies perform poorly, then it's really going to hurt that passive return. Of course, going back to what you said, if you can set it and forget it as a strategy, you don't have to worry about these little movements in the market. But I want to key in on what you said, is that the problem is when a lot of people undertake this on their own, they get scared in bad markets. I mean, I saw people who during COVID, when the market dropped 20%, they decided to pull out because they were afraid that everything was going to go away. And then usually the issue is not whenever they get out, but it's them making the decision to get back in. And a lot of people waited far too long, didn't get back in until maybe close to the top of the market at the end of 2021. And then, of course, they got hit with 2022 and a bad year after that. So, for anyone who is passive investing, I think the whole point is staying invested. And even if you are investing actively with someone like ourselves, you want to be constantly investing in the areas of the market that are going to make the most sense. Of course, there's going to be periods when cash is an attractive asset class, but maintaining some kind of investment and having someone to talk to kind of back you off from pulling money out or pushing too much money in at the wrong time can be something that's pretty valuable.
Yeah, and that kind of goes into through security selection and having a little bit more of a systematic approach to investing, you kind of you have a better understanding of what companies you're invested in, why you're invested in them, and that why is a lot more important. Because one thing that we like to remind people is that you're not investing just in a stock and a number and a ticker symbol, but you're owning part of an underlying company. And while the valuation of these companies fluctuates and can fluctuate wildly in certain market environments, it's still at the end of the day the same underlying company. And if it's a good one and you own it for a reason, then you'll be able to maintain a lot more conviction to ride it out through those bad times, so you don't worry about getting out at the wrong time. And usually, like you mentioned, the problem is you don't get back in until it's much, much higher.
Right. And I think that's something that you and I focus a lot with our clients, is that educational aspect, is know what you own and why you own it, and why those trades are being made, because it's a lot easier to stay on that investment journey whenever you have someone telling you, hey, this is why we own these things. It isn't just a piece of paper with a number on it. It's a portion of a company. That stock is a real percentage of that business. And just putting that into context, kind of opens people's eyes, kind of gives them some insight into that. And then, they start to understand, hey, this investing thing, it's not just trying to make money off of pieces of paper. It really is like owning portions of these companies. And if we have good outlooks for those companies, if they seem to be attractive valuations, hey, maybe I can make a lot more money, down the road by investing in these. And then I do want to say that throughout this conversation, I don't want to pick any individual point in life or really dollar value where it makes sense to go from kind of your passive investing where you can do it yourself to hiring a professional to help you with that investment journey, because everyone's financial situation is different. I will say that as your assets increase, typically your financial picture gets more complex, and that's where it's going to make more sense to work with someone on that investment journey. I will also say that if you're younger, it's easier to be passive because you've got a longer time horizon. If you're close to retirement, it becomes more important to work with someone to help you with that journey. And then I really want to focus in on what I think is probably the most critical piece of the passive versus active conversation is the tax implications. And that's kind of why I bring it back to, hey, it depends on your asset level, your income, because if your income isn't super substantial, then the tax burden of your investments is also probably not going to matter that much. But whenever you're talking about passively investing in an index versus having individual holdings, whenever you're going to either pull money out, make a trade, buy or sell something, it's a lot easier to manage that tax situation when you have a variety of holdings versus just an index, one line item on your investment balance sheet.
Yeah. And so that's very important as you have high levels of income or getting close to retirement, but it's also very important earlier in life too. We were talking about buying a house your first time. So you're buying your first house. Well, that usually happens earlier in life and is even just the down payment nowadays. I mean, that's a considerable amount of money. And with a passive approach, you're just selling the ETF or whatever you're holding, and you have to sell everything all at the same time with no consideration for tax treatment. And so all of those gains that you have over the past, 5-10 years of putting money away into this vehicle is taxed at your, hopefully long-term capital gains rates, but it's all taxed, and there's no opportunity to offset it with strategic losses or, sell certain things to, change your allocations or anything. It's just, you have to sell everything, and it doesn't really give you a whole lot of that optionality like you were talking about.
Right. And just to kind of go through that a little bit further. I mean, when you're talking about having multiple line items on your balance sheet and those multiple tax slots, like you were alluding to, if one position is down, it can be sold. And then if you actually like the company, you can buy it back 30 days later, but you've captured that loss out of it to write off against any potential gains that you have in those other companies on your investment balance sheet. And then, so that creates an immediate benefit. Or if you're just looking to capture losses on a short-term period, maybe it's a company you don't want anymore, it's lost, call it 10%. You can pull that out, use it to offset gains in the future. Like you were saying, if you've got one line item and that's your S&P 500 index and it goes up or down, well, the only, gains, if it's down and you sell it, well, you have to wait 30 days to buy that back. But then you're only offsetting future gains from it as well. So you're not talking about a combination of, hey, this company's doing well, this one maybe did a little bit poorly, now I can balance my tax situation while staying invested. But now you're talking about selling the one line item that you have. And so, I guess this is kind of a point to make, is that even if you're going to go the passive route, maybe diversify across a few ETFs, just because that tax situation can actually matter a lot when you're talking about making a big purchase. If you're talking about liquidating, call it 25% of your investment portfolio because you are putting that down payment on your first house, well, it'll help a lot if you can manage that tax situation, because at the end of the day, you don't really want to be paying, even at long-term gains, call it 20% on the gains that you made in that investment the following tax year.
Yeah, exactly. And so I kind of want to move to talking about active security selection. So we've mentioned a number of benefits to it. There are also a couple drawbacks. I mean, because it's, mainly in the realm of complexity and just sophistication, because it turns something that was, one of the big advantages of passive is that it's very simple. You have a couple of ETFs, maybe a handful, that really replicate market performance, and you don't have to worry about it too much. So active security selection, it does add a layer of complexity to it, which you can either take on by yourself, which, if you want to spend your retirement doing that, then that's great. But it's, it can be a lot. can be a lot for people. And it, depending on it, the additional gains or even potentially, underperformance might not be worth that to them. And then going to a professional firm, you're talking about, you have a fee involved. So that's a higher fee than you're going to be paying on these ETFs. So you'll be really banking on the extra tax benefits and potentially extra alpha in order to offset that. And so I think, we were talking about earlier about this, but there are really two things you can control in your investment journey is, what your allocation, like what money you put in or take out, as well as your taxes. And I guess additionally with that is what fees you pay. So if we're agreeing to higher fees, one of the easiest ways to take that back out is through more tax efficiency and avoiding that, like you're saying, 20% on all of this money, call it $100,000 that you're pulling out. 20% is a big tax burden for a lot of people. And so but to manage that better, if you can whittle that down, a couple percent, all of a sudden you're coming out ahead.
Right, exactly. And I think that is the big differentiator. Like you said, I mean, fees and taxes are the two things that you can really control in the investment journey. Of course, you and I, our job is to really seek those outsized returns while limiting volatility in portfolios. But the market is going to be volatile at the end of the day. These are risk assets. So, in some years, like we saw, over 2023, so far into 2024 has been a couple of great years, great last 18 months. 2022, not the best year. And so markets are going to shift, but focusing on the things that you can control is really important. That's why you and I, whenever we're picking securities, we choose individual equities, remove that ETF cost that's kind of layered on top that a lot of fund managers opt for. But then, if you are passive investing, if you're doing it yourself, look for those low cost index funds. A lot of the S&P 500, NASDAQ, those funds carry low fees. And so that's a better way to go if you are going to go that route.
Yeah, but one thing I think that's worth calling out for our audience is that even within S&P 500 ETFs, you can have, there are loads of them, but you range from in fees by fairly considerable amounts. Some of the most famous popular ones are actually the highest fee. So, just one of those practical points to keep in mind is that whenever you're looking at these things, pay attention to the fees that you're paying within those ETFs because they're not all the same.
Right. And then I think going back to why you would potentially invest actively is a critical piece of that is making sure that you're properly diversified. So the thing is, if you are going to go through the undertaking, whether it's by yourself or with professionals, in this business, is making sure that you have enough holdings to actually adequately diversify yourself. There's typically this kind of like rule of 20 in investment portfolios, have at least 20 companies. We would opt for more than that. Most of our portfolios typically have on the equity side, I'd say, somewhere around the 50, 60 range, just to make sure that if one company does have a serious issue, it's not going to blow up your portfolio. So that's a really important piece. And then I think the other benefit is, if you do choose to work with a professional and a licensed individual, and this kind of goes back into what kind of phase of your wealth journey are you on, you are going to have access to things that are not just your S&P 500 stocks or your publicly traded bonds. An investment manager can get you access to private equity, private credit, all sorts of other alternative investments, private real estate, structured notes, things that are going to help with that risk reward dynamic. Of course, those make a little bit more sense as your assets grow, but is certainly something to consider. And we've talked about that before in prior podcasts, but something to consider when trying to make that decision.
Yeah, definitely. And then, again, to your point, as those assets are higher, you can bear that illiquidity premium a little bit better. And that's, kind of untaps or another avenue of return for all of this. So being able to take that illiquidity, really, it helps along the way. And then those more sophisticated products that you either generally don't have access to as an individual investor. But, I think one of the big takeaways, regardless of where you are in your investing journey, what level of wealth you have to invest with, is the get invested and stay invested.
Exactly. And I think those are really important things to think about. Hopefully we gave our listeners some things to consider if they're trying to make this decision. And this is always an ongoing decision to make. On a yearly basis, you're going to think about, hey, what am I going to do with my finances? Do I want to stay passive? Do I want to go active? What's that process look like? And a note to our listeners, if you are thinking about this conversation, please drop us a comment. We're happy to kind of, on a non-public forum, of course, review your financial situation, try to help you make that determination whether or not investing actively or passively makes sense. That is our job at the end of the day. So we're happy to give some advice to individuals when they're trying to make that decision for themselves.
Yeah, definitely.
All right, Hunter. Well, thanks for another episode, and we'll see everybody next time.
Great. Thanks.